Hello, welcome to my blog, Accountant Cam. My name is Cameron Andriola, and today I'm going to be discussing a presentation on the Mortgage Debt Relief Act of 2007. I chose this topic because many homeowners, unfortunately today, are still facing issues such as foreclosure and short sales, and there are some important tax considerations that they need to be aware of. So a little bit of background on the Act. This act allows taxpayers to exclude their COD income from the discharge of debt on their principal residence. As I said, this usually is an indication of a foreclosure or a short sale. It's limited to $2 million per taxpayer, and it was created to attempt to lessen the blow of tax consequences from the housing market crash. So Congress felt that you as a homeowner, if you were struggling to keep your house and unfortunately lost it in a foreclosure, they didn't want you to have to face this huge tax burden as well. It was recently extended until December 31st of 2013, so it is available for the next tax filing year. There is one important exception with this exclusion. It does not apply to the discharge if it was not in direct correlation of your home's value. So usually this means either a refinance or a second mortgage, and that those funds or proceeds were used for personal expenses. They were not put back into your house. So I gave a quick example here below. You purchased your home in 2005 for $200,000. You incurred a refinance in 2006, in which case you used $40K to pay off personal credit card debt. And then unfortunately in 2012 your house was foreclosed on and you had an outstanding mortgage of $220,000. So under this provision, you can exclude all but the $40K from the refinance. However, this is just one of 6 federal COD provisions, and it is still possible for this taxpayer to have no taxable income. Let's take a look at those COD provisions. So I already talked about number 5, which is the qualified principal residence indebtedness. Number 2 is a common one that we often see with taxpayers. This is a discharge due to insolvency. What do we mean by insolvency? Well, the IRS has provided a worksheet here so you can calculate the extent of insolvency. Basically, in Part 1, you need to list all of your liabilities immediately before cancellation. So you would include such things as credit card debt, the outstanding mortgage on your foreclosed home, any auto or vehicle loans, and there is quite a list of other items as well if you have any other outstanding debts. Then in Part 2, you need to list the fair market value of your assets. Now the important thing is to list the fair market value, not historical cost. And also you need to include the home that was foreclosed on in this because it is immediately before cancellation. So in that case, you still owned it before the house was foreclosed on. So if in this calculation, Part 1 is greater than Part 2, and in the previous example I gave you, there was $40,000 of taxable income, if you can show that you were insolvent to at least the extent of $40,000, then that taxpayer wouldn't have any taxable income for this year. So let me give a quick highlight of the steps to calculate those exclusions. The first one is you'd have to calculate the disposition of a principal residence. This usually does not result in any taxable income, but even if your home was foreclosed on, you still have to treat it as if you sold it. So if there was a gain to be had, there could be a taxable income just from the Foreclosure Act itself. Then in step 2, we applied the qualified principal residence exclusion. And as you saw, everything but that $40K from the refinance was excluded. Then in step 3, we looked at the extent to which the taxpayer was insolvent. If the taxpayer was insolvent by at least $40,000, then they wouldn't have any taxable income, which is step 4, where you can apply both the principal residence exclusion with insolvency. Now there is an important consideration, and I'm not going to have time to get into it in this presentation, but you may need to reduce the basis of other tax attributes as a result of this. So this was my presentation today, and I hope you found it useful. If you have any thoughts or comments or questions, please feel free to contact me or reach me at accounting